Imagine this. You hear about Bitcoin everywhere. News headlines, social media, stock tickers, friends bragging about gains. But if someone asked you a simple question, what does it actually mean to own Bitcoin? Could you honestly explain it? For many people, the real answer is more complicated than they realize. So today, we're going to break it down in a way that feels natural, logical, and a little surprising. And by the end of this video, you'll understand Bitcoin not as magic internet money, but as an incredible solution to a fascinating problem. Welcome to the Crypto Loop. Let's rewind for a moment. Forget Bitcoin, forget blockchain, forget crypto. Just imagine you and a group of friends who split bills, share expenses, and constantly pass money back and forth. It gets annoying to settle everything with physical cash every time someone pays for lunch or drinks or gas. So instead, you come up with a simple solution, a shared ledger, a public list where anyone can record the transactions they owe or receive. Alice pays Bob $20. Bob pays Charlie $40. Simple, written down, visible to everyone. At the end of the month, everyone sits down, checks how much they owe or are owed, and settles the balance in cash. Anyone can add a line to this communal ledger. It's simple, and it works at least until someone decides to cheat. What stops Bob from writing "Alice pays Bob $100" without Alice ever agreeing to it? That's where cryptography enters the picture, specifically digital signatures. If Alice wants to make sure everyone knows a transaction is truly from her, she attaches a digital signature, not a handwritten squiggle, but a mathematical fingerprint that proves she approved that payment. Behind that signature is a private key, a number only she knows, and a public key, something everyone else can use to verify that the signature is real. The signature can't be forged, copied, or applied to a different message, because even the smallest change in the message generates a completely different signature. This means no one, not your friends, not strangers, not hackers, can fake your approval. Digital signatures solve the first major trust problem. Every transaction must be approved by the sender, and it's mathematically impossible to fake. But we've still got a bigger issue. Even if every transaction is signed, we're still relying on the honor system when payday comes around. What if Charlie racks up thousands in debt and simply disappears at the end of the month? What if he just never pays? That's when another powerful idea emerges. Instead of settling in the real world, why not treat the ledger itself as the currency? Imagine everyone contributes 100 credits to start. Now the first entries in the ledger say, Alice gets 100, Bob gets 100, Charlie gets 100. No one can spend more than they have listed on the ledger. If Charlie pays Alice 50 and then pays Bob 50, he now has 0 remaining. If he tries to spend 20 more, the network rejects the transaction. No meeting, no cash, no trust needed. The ledger is the system. The ledger becomes the currency. At that moment, something incredible happens. You have invented digital money. It can exist independently of banks, governments, or physical notes. And this is the foundational concept Bitcoin is built on. The history of transactions, who sent what to whom, is the asset. The ledger isn't just a record, it is the currency. But there's still a big problem. Up to this point, someone has to host the ledger. Someone has to run the website or computer that stores the list. Whoever controls that machine controls the system. And if we want true digital money, we need to remove that central point of control. So the next step is decentralization. Instead of one ledger on one server, everyone in the system keeps their own copy. Every user maintains their own full transaction history. When someone makes a payment, say Alice pays Bob 10 credits, the transaction is broadcast to everyone who listens and is recorded on every copy of the ledger. But now we hit the real challenge. If there are thousands of ledgers being kept by thousands of people around the world, how do we make sure everyone agrees on the same version? How do we prevent someone from claiming a different history? How do we stop someone from spending the same money twice? This problem is the heart of the Bitcoin invention. Satoshi Nakamoto's brilliant solution was this. The correct ledger is always the one that required the most computer work to create. But how do you prove work mathematically? Enter cryptographic hash functions. A hash function takes any input, a message, a sentence, a list of transactions, and converts it into a unique 256-bit output. Change the input even slightly, and the hash changes dramatically. And these hashes are one way. There's no shortcut, no trick, no reverse key. If you want a hash that starts with 30 zeros, you can't calculate it backwards. You have to guess repeatedly until one works. If the chance of success is 1 in a billion guesses, then someone who produces such a result must have done that work. This becomes the backbone of proof-of-work mining. Miners bundle a list of new transactions into a block, then race to find an additional number, called the knots, so that when hashed, the block's output begins with a certain number of zeros. If they succeed, the block is valid and can be added to the chain. As a reward, the miner receives freshly created bitcoins. This system means creating a valid block takes real-world time, real-world energy, and real computing power, but verifying it takes only a moment. And here's the key rule. If two versions of the blockchain exist, one real, one fraudulent, everyone trusts the one with the most accumulated work. For an attacker to rewrite history, they would need to outcompute the entire rest of the network. Unless they control more than half the total mining power, their version will always lose over time. That is why Bitcoin works without a bank, a CEO, or a central server. It is secured not by trust, but by math and computation. Over time, block rewards decrease, but miners still earn transaction fees. As long as people make transactions, miners have financial incentive to maintain the chain. And while block limits and Bitcoin's transaction capacity are often criticized compared to systems like Visa, the core design remains solid. Bitcoin prioritizes security and decentralization above sheer speed. And that, in the simplest honest terms, is what it means to have Bitcoin. You don't own coins in a vault. You own a place in the public history of digital transactions, a ledger secured by millions of machines and billions of calculations. You own value proven by math, not guaranteed by authority. If you've made it this far, you now understand Bitcoin far better than most investors. And if you found this breakdown eye-opening, share it with someone who still thinks Bitcoin is just digital money. Because clarity matters, especially in a world where capital is flying into crypto faster than ever. Thanks for watching the Crypto Loop. If you enjoyed this deep dive, hit like, subscribe, and share the video to support the channel. I'll see you in the next one.